Hello, and good afternoon. My name is Yaron Golgher. I'm the CEO and the co-founder of I Know First. I Know First is an AI company. Our main solution is predictive algorithm that generates daily prediction for the financial markets and identifies the most promising investment opportunities. We are utilizing artificial intelligence, machine learning, more specifically deep learning, and artificial neural networks to predict the financial markets. Our algorithm is generating daily forecasts for over 10,000 assets from different asset classes, equities, commodities, currencies, ETFs, world indices, as well as interest rates with predictions for different time frames, long-term, mid-term, and also short-term. We are currently covering most of the stock exchanges around the globe, including US, of course, Canada, Mexico, most of the stock exchanges in Asia, Europe. The brain behind the algorithm is going to talk right after me, Dr. Lipa Roitman from the Weizmann Institute of Science in Israel, one of the leading experts in the field of AI, artificial neural networks, and chaotic systems, and this is what he's going to talk in his presentation. Dr. Roitman is leading quite unique R&D team that based on PhDs, AI and machine learning experts, data scientists. We are working with math professors as part of the core team, as well as employees with the background of math and statistics. So what we are providing on one end predictive solution as a decision supporting tools to institutional and retail clients from all over the world based on the stock exchanges that are relevant to them. On the other end, we are also developing AI-powered investment products in a partnership with institutional partners, mainly banks, hedge funds, and wealth management firms. We will get back to this slide later on. So to sum up, by utilizing the algorithm, it's possible to identify investment opportunities and to receive daily trading ideas. It's possible to receive stock market intelligence regarding the direction of the market, to compare different regions and sectors, and to identify the most promising ones. And it's possible to integrate it to the entire investment process, from the strategic level of the asset allocation to the research and the advisory, and also to conduct the stock picking for each region around the globe, actually. On the other hand, it's possible to utilize the algorithm in order to construct a portfolio. We have developed several systematic trading strategies that we will see later on, and the idea is to convert each strategy into AI-powered product, mutual fund, smart beta product, or ETF. So how we do it? Every day, the algorithm is collecting quantitative data sets from the entire financial markets. We are adding the daily data to our historical database. We are managing database with over 15 years of historical data. And around the clock, the algorithm is learning from the new data, learning from the historical data, identifying the patterns in the market, learning the behaviors, and generating the prediction for each region around the globe. We have one window of forecast generation for the east side and one window for the west side of the world. Now, one of the most interesting inputs that we are utilizing, or that the algorithm is utilizing, is not coming from the market, but it's coming from the past predictions of the algorithm. As self-learning algorithm, the algorithm is also utilizing the past forecast, the past successes and failures, as one of the most important inputs. In terms of the technology, we are combining different methods into one machine learning algorithm. The leading one is deep learning, artificial neural networks, supervised learning and reinforcement learning, as well as genetic algorithms. Now, what's interesting about this algorithm is that each forecast comes with confidence level. In the markets, there are assets that are more predictable and there are assets that are less predictable. And by utilizing the algorithm, it's possible to separate the predictable part from the part that is not predictable, and from this investment universe to identify investment opportunities to generate trading ideas and also to develop systematic trading strategies. So every day the algorithm is generating the forecast in the form of an heat map. You can see it on the left side of this slide. The green cells represents positive prediction. In each cell, it's possible to see different assets, different stocks in this case, but we are generating the very same heat map from different asset classes. So the green cells represent positive prediction, the red cells represent negative predictions, and what the algorithm is generating on a daily basis, the algorithm is generating ranking for each stock exchange. So the assets that located at the top part of this heat map are the ones with the highest expected return, and the red ones on the bottom of this heat map are the ones that you should actually short sell. We can see here different indicators that the algorithm is generating on a daily basis. The first number is the signal. Signal represents the predicted movement of the specific assets or the expected return. And we are utilizing this indicator, the top one, in order to create the ranking for each stock exchange. The second independent indicator that we are generating called predictability. This is the historical correlation between the past forecast and the actual market movement. It varies between -1 and 1, and the more predictable the asset is, we are going to see here higher values. And it's based on all the analysis that we have conducted, it's super important to focus on the assets that, of course, more predictable than others, and also on the assets that have the highest expected return. So based on this solution, we structured tier solutions offering. The first tier that we see on the left side of the screen serves as a decision supporting tool that helping to investors or traders to take a better decision every day in the market. It's possible to utilize it in order to identify investment opportunities or to support the current investment process. It's possible to focus on specific sectors, to set different fundamental criteria, or to monitor a specific portfolio or investment universe. On the other hand, it's also possible to focus on specific region around the globe or specific sector. On the other end, we have, on the right side of the screen, we have developed also wealth management solution that converting the daily forecast into a portfolio. The idea here is to build a portfolio, including the entire allocation process and the adjustment process of the portfolio, and to convert it to systematic trading strategy that could be converted also to financial product. So we have developed strategies for based on the short-term signals, based on the short-term forecast. We can see it right here. This strategy is focusing on S&P 500 stock. This is the red line that you see here, and the different strategies that you see on the top part representing the different strategies that we have developed based on our algorithm. It's important to highlight that this is actually not a simulation or backtest. This is based on the real forecast that our clients are receiving on a daily basis. It's not that we took the data now and we trained the algorithm and we tried to see what we could achieve in the past. This is based on the specific forecast that our algorithm generated in a very specific date. We have developed also strategies for the long term that focusing on the long-term forecast, for example, this strategy. Here, the rebalancing is done every month, and we are focusing on the 3-month forecast. And we have also strategies with weekly rebalancing, for instance, this strategy. And strategies that focusing on ETFs. This strategy is really interesting because we are integrating the individual AI stock forecasts to the region and to the sector level, and we are just focusing on the sector or the region that has the strongest signal by using the ETF that representing the very specific sector or ETF. We can see here the 2-year performance actually until last week of the algorithm based on the S&P 500 universe, and we can see the performance of the different time frames that we are predicting on a daily basis. This is an excellent example where we are focusing on the top 3 stocks in terms of the predictability, on the top 10 stocks in terms of the signal. And here's the results if we are comparing ourselves to the S&P 500. Generally speaking, we are working with banks, wealth management firms, and hedge funds. Some of the strategies that you have seen here are utilized by them. In the bottom of this slide, it's possible to see the partial list of the stock exchanges that we are covering around the globe. For the second part of the presentation, I would like to invite Dr. Roitman to provide an overview of the technical overview of our algorithm. Please, Dr. Roitman.
Just a second. Thank you. I am Lipa Roitman. I'm head of R&D of INOFirst. I'd like to talk to you today about the chaos theory, about how we view the market as a just a second, let me control the clicker first. No. Oh, no, that's back. How do I go forward? Yeah, okay. We'll talk about the market as a chaotic system, how to quantify chaos, how to model chaos through machine learning. And then I'll talk about a little bit about the functions of our algorithm. What is chaos? Chaos is a property of nature. It's a property of complex systems where there are many participants, it's a dynamic system where each element affects others. And the examples are weather, weather forecasts, epidemics, spread of epidemics, social behavior. There are examples in physics, in astronomy, and quantum mechanics. But we are talking now about markets. What is the reason for chaotic behavior of the markets? It's very simple. There are many different players in the market, each with its own objective, each with its own valuation methods. There are people who love fundamentals. There are people who love price momentum. There are people who invest in different time horizons, longer view or short time horizons. And there are different reaction times. People react, and there are algorithms, machine learning algorithms, and so you can have. There is another aspect of why the chaos is in the markets is the irrationality of people. There is a theory of risk aversion that was for which Kahneman and Tversky got Nobel Prize in economics, which says that people are more sensitive to losses than they enjoy the equivalent gains. And that causes imbalance in the behavior in the markets. There is more irrationality in trading. There is a latest news bias where people simply react to latest news and forget what was yesterday and the day before yesterday. And there is an overreaction because people can't quantify the news. There are two kinds of people. The people who are buy on dips and the people who like trends, and they both coexist in the markets. So all this creates a lot of uncertainty and imbalances in the market. So what are the properties of chaotic systems? Chaotic systems have basically two time periods. There is a period of stability where the market has memory. What happened next depends on what happened before. And there is a slow accumulation of imbalances where eventually everything breaks down, and then there is some kind of trigger happens that everything changes. There's a paradigm change. Now, another property of the market is fat tail distribution. What it means that if you look at the returns of the market statistically, you'll find that there are much more frequent extreme events that would not be predicted from normal distribution, from Gaussian distribution. And if you try to use just a normal distribution, you'll be surprised by how much is the difference between the real returns and theoretical returns. Now, how to quantify it? How to quantify chaos? So we actually have built a theory. The markets are what are the markets? Complex, self-organizing, chaotic systems. They are evolving systems of interdependent global and local processes. There are many players in the market, many like asset prices, exchange rates, and so forth. They all affect and are being affected to varying degree. Now, there are two feedbacks. There is a positive feedback and negative feedback. Positive feedback is a result of optimism. People invest in successful companies. The price goes up and up. And there is also, eventually, there is a negative feedback. People ask, did the price go too far, too fast? So all these two feedbacks interact in a complex way, and they create what we call bubbles. And now we'll talk, now how do we describe volatility? What is volatility? Volatility, you can describe it as a scale-dependent market noise. Now, what is noise? Noise is actually what you don't know the reason of. If you know the reason of it, it's not noise, it's a signal. So what for some observer is noise, for another observer it could be trend, and he could use it. And also another important part, that the bubbles exist at any time scale and a price scale, and they're all inherent in the markets. There is no way to get rid of them because that's part of the process of the market. So now how do we describe them mathematically? I have to introduce shortly two concepts. There are wavelets and fractals, and they're both connected, and that's how we model the markets. What is a wavelet? When we analyze time series, you can't use Fourier transform that would be used for regular simple physical processes because the markets are non-stationary and non-ergodic, which means that they are always changing, and there is no, you can't learn from one part of the market what will happen next from another part of the market if you look at a single time series. Now, for such, so you can't use Fourier analysis. Instead, we use wavelet transforms. Wavelets are used instead, which are used for non-stationary systems. Now, what are fractals? Fractals are complex systems that have self-similar properties at different scales. It could be a different time scale. It could be a different physical scale or price scale. And such systems are good approximations of chaotic processes. Now, if you compare regular statistics with a fractal one, in a regular statistics, you have variance and mean. And the fractal analogy for variance is fractal dimension, which points to local irregularity, complexity of the system. And there is an analogy of mean is a Hurst exponent, which measures the global persistence, trendiness. Now, when we analyze the markets, you'll find three types of noise, you can call it volatility. There is a random white noise, which has no correlation in time. There is a Brownian motion. That's it? I didn't even start, sorry. I can, okay, I'll be talking, I'll be cutting it short a little bit, but I need to talk about at least the last part. What our algorithm does. We use multivariate time series modeling. We use many different inputs. There are different challenges of learning the market. It's a non-stationarity. The circumstances never repeat exactly. There are black swan events that are difficult to learn because there are so few of them. And there is data that we'd like to have, but we don't. There is data we don't even know that exists, hidden variables. So what do? We use self-supervised perpetual evolutionary learning. The system absorbs new information daily, generalizes, predicts in uncharted territory, plurality of forecasts from multiple points of view. We forecast multiple time horizons. We use measurable predictability. We use automatic input selection that refines constantly refining the model. We have a cloud of predictions that allows us setting the trading parameters. We know that we know what variables are affecting the system. It's not a black box. It's we know exactly what influences the market, and we can, because of that, we can conduct what-if scenarios, finding cause and effect. Actually, everything the machine learning does actually agrees with what economics professor would say. So, and it's all the result of machine learning, because the computer doesn't actually know what we put in. It just derives the relationship simply because there are relationships. We don't input any economic parameters. It finds them themselves. So that's actually quite amazing. It's really artificial intelligence. Thank you very much. Thank you.